Hey everyone, welcome back to Corporate Decoder. Today we're diving into a company that's facing a bit of a financial tightrope walk. We'll see if they can pull off a comeback if they're heading for a fall. Sounds intriguing, right? Today we'll be talking about Q32 Bio and their recent filing where they got a notice from Nasdaq about not meeting the minimum requirements to stay listed on the stock exchange. This could mean big changes for the company and its investors. Before we jump in, if you're into understanding the real story behind these corporate filings, make sure to subscribe. Also, we've got a Discord community linked below where you can chat with other finance enthusiasts, so come join us. So what happened? On May 19th, Q32 Bio received a letter from Nasdaq saying they weren't meeting the requirements to stay listed. Specifically, they didn't have enough stockholders' equity, which is basically the value of the company owned by its shareholders, after subtracting what it owes to creditors. The minimum requirement is $2.5 million to creditor and $5 million to creditors. The minimum requirement is $2.5 million. Their report showed a stockholders' equity deficit of about $4 million. That means they're actually in the negative, owing more than they own. This isn't just about not having enough money in the bank, it's a serious signal about the company's financial health. It also looks like the company didn't meet the other requirements, either the market value of listed securities of $35 million, or net income from continuing operations of $0.5 million, or net income from continuing operations of $0.55 million in its most recently completed fiscal year, or in two of its three most recently completed fiscal year. Or in two of its three most recently completed fiscal year, or in two of its three most recently completed fiscal year, or in two of its three most recently completed fiscal year, or in two of its three most recently completed fiscal year, or in two of its three most recently completed fiscal year. The company says this problem is partly due to how they accounted for getting back the rights to a drug called bempikibart from Amgen in 2023. Let's break this down a bit. Back in 2022, Q32 Bio Inc. had a deal with Horizon Therapeutics, now owned by Amgen, to develop bempikibart program at a set price, but then Amgen bought Horizon and later Q32 Bio got the rights to bempikibart back in 20 baht, back in $5 million from Horizon. Horizon then had the option to acquire the bempikibart program at a set price, but then Amgen bought Horizon and later Q32 Bio Inc. $5 million from Horizon. Horizon then had the option to acquire the bempikibart program at a set price, but then Amgen bought Horizon and later Q32 Bio got the rights to bempikibart back. Because of this, Q32 Bio got to keep the $55 million they already received. However, they also agreed to potentially pay Horizon up to $75.1 million in the future if certain milestones related to the drug were achieved. This potential future payment is currently listed as a liability on Q32 Bio's balance sheet. This accounting treatment is impacting the company's deficit in equity. Basically, the way the accounting rules work, having that potential future payment hanging over them makes their financial situation look worse right now. Now, Q32 Bio has 45 days to give Nasdaq a plan to show how they'll get back on track. If Nasdaq approves their plan, they could get up to 180 days to prove they can comply. If not, they can ask for a hearing to argue their case. For now, Q32 Bio stock will continue to trade on the Nasdaq under the ticker symbol QTTB. The company says it's looking at different options to get back in compliance with Nasdaq's rules, but there's no guarantee they'll succeed. It is important to note that there is no assurance that Nasdaq will accept the company's plan, that the company will be able to regain compliance with listing rule 550 by line 5, or that the company will be able to regain compliance with listing rule 5005 will accept the company's plan, that the company will be able to meet the continued listing requirements during any compliance period that may be granted by Nasdaq. Of course, the company includes some forward-looking statements, which are essentially educated guesses about the future. They caution that things might not go as planned and that real results could be different from what they're hoping for. This is standard practice as they need to cover themselves legally in case things don't go their way. This report was officially signed by Jody Morrison, the Chief Executive Officer of Q32 Bio on May 23rd, 2025. Now let's zoom out and analyze what this all means. The big issue is that Q32 Bio doesn't meet Nasdaq's minimum requirements to stay listed. This could scare away investors. Why would you buy stock in a company that might get kicked off the exchange? It makes the stock harder to trade. The negative stockholders' equity is a major red flag. It shows the company owes more than it owns, which isn't a good sign for its long-term survival. While the company is blaming the way it has to account for the bempikibart acquisition, it doesn't change the fact that this is a serious problem. Q32 has to convince Nasdaq that it has a realistic plan to improve its financial health. Ultimately, Q32 Bio is in a tough spot. They need to act fast to convince investors and Nasdaq that they can turn things around. They have 45 days to present Nasdaq with a plan to turn things around. What do you think about Q32 Bio's situation? Do you believe they can turn things around and get back into compliance with Nasdaq's listing requirements? Let us know in the comments below. And if you found this analysis helpful, please hit that like button and subscribe for more deep dives into corporate filings. Also, don't forget to join our Discord community. Thanks for watching, and we'll see you in the next video.